Welcome once again, Indiana to Wealth in the Winner's Circle with Harley Shanklin and Dave Williams of RDW Financial Group. I'm Spike Spangle. Gentlemen, how are you doing this week?
Phenomenal.
Fantastic. Great. Good. I got double barrel.
There you go.
It's like double exhaust. They're both blowing me at the same time. We got a very exciting show today. Please don't go anywhere. Using some of the tools that so many of you out there, including myself, have to save for retirement, there can be some flaws in the old strategy that's been around for 4 decades. That's exactly what we're going to talk about today. Harley, I'll start with you. To contribute or not to contribute, you sent me the top of that in an email. What in the world does that mean?
Yeah, well, for Spike, it's all about, we're told all of our working lives that we need to contribute to our retirement accounts. For those of you out there who have a 401k or an IRA, that's what we're told we're supposed to do, is to put money in consistently over time into what are known as qualified plans. And basically what that means is they are qualified to defer the taxes, which is often why they're called tax-deferred accounts, right? Because we are deferring that tax to a later date. And the question becomes does it make sense to defer the taxes? And that's really the question maybe a lot of you out there have, is where should I be saving my money? And that's one of the things that we tackle when folks come in to visit with us.
Dave, as you had a previous career, an astounding career before that, I'm sure you had something like a 401k that you saved into. In fact, I think it was one of the levers and reasons that had you create the firm here is kind of the management of these. Now, when you started saving in these, weren't tax rates a lot higher back in the 80s than they are right now?
Oh, you're going to force me to show my age, aren't you?
No, you're the youthful guy up here.
When they started the 401ks. So yeah, they were tax deferred. And yes, interest rates were a lot higher back then. The philosophy was this: pensions were going away. You no longer could rely on your company, so you had to start saving yourself. And here was the statement. Ready? You're going to spend less money today putting your money away for retirement because it's tax deferred. You don't have to pay tax on that money. You won't have to pay tax on it until years down the road. And unfortunately, what we know is that it's really just a loan on that tax deferral. The government's loaning you those taxes with growth over the period of your lifetime. Think about this. So you put in 6% and you don't pay, let's say you're in the 22 or 25% tax, 25, you don't pay tax on that money. But that grows for 30 years and you've done a great job, and 30 years later you now have $1 million in this IRA or 401k. So here's the truth: you don't have $1 million. What you really have, if assuming the tax bracket's still the same, you have about $750,000, because the government's going to take $250,000 of that tax money as you start taking it out. At a minimum. I'm being kind here, because honestly today, if we know it, tax rates are probably going to do what? Go up. There you go.
Yeah. So when we're looking at our accounts, somebody comes in, because you've talked about that pile of paper, the shoebox of everything they bring in. They say, well, I've got X amount of dollars. I've got Y amount of dollars. And you're like, no, you don't. I mean, wait a second. It's right here on my statement. What do you mean I don't have that? Because we've been kicking that tax can down the road. Now, we're going to talk about some solutions. We're going to talk about some things that you can actually do to change that situation, and maybe some things you can do if you are still working right now. Harley, I've got to ask you though, you're not saying to stop contributing to your retirement savings.
Absolutely not. I'm not talking about don't stop contributing to your retirement accounts.
I feel like Spike, don't even say that out loud.
Don't do that. Don't do that. But you should have a plan and a strategy that goes along with how you are saving, because we want to look out into the future to see what you're doing today, what sort of impact is that going to have on you when you reach retirement and as you go through retirement. Because that's the other important aspect of it, Spike, is that, right, retirement doesn't just start, it continues, right? It goes on, and we want to make sure that we are looking at what your tax situation not only is today, but what it's going to be through retirement, and what sort of impact how you're contributing is going to have to that.
Dave, one of the producers just kind of shot into my ear right now, because I had said, the tax rates were higher.
Right.
The highest tax rate back in 1980 was about 70%.
That's correct.
Highest tax rate effective today is about 39%. So it was almost double. So I get it that your employer came to you and said, look, if you save money into here, you get to subtract it from your income, and that's a nice tax savings.
It is.
But tax rates have come down over the last 4 decades, and I don't really hear anybody except you two guys right now talking about, hey, maybe we want to pay the taxes. But are there other tools you can save besides that 401k or 403b or 457?
Oh, sure. So there's a number of savings vehicles out there that many of you are probably contributing to in some sort of way, whether that is just your standard pre-tax 401k, but with the Secure 2.0 Act, they expanded that to have Roth 401ks. Those are much more available now. We've all heard of the Roth IRA out there where we get to put money in that grows tax-free. It'll be tax-free for you, your family members. So there are a lot of other options besides just the pre-tax 401k or pre-tax traditional IRA. We want to start to look at the value of a Roth IRA or Roth 401k and what sort of benefit that can have for you and your retirement plan.
As you guys know, with any sort of racing team, there are many different components to it. So I'm about to give you the steering wheel on the RDW Tax Test. I'm going to let you explain what it is. So folks, as you're seeing this right now on the bottom of the screen, this is a free tool. So many of us have been saving tax deferred for 3 decades, 4 decades, or more. The team here has put together this free tool. You can type that into a web browser, or you can just scan this QR code and click on it and go over to it. It is a couple of simple inputs, and it's going to show you exactly what your taxes are. So what are we looking at here?
It's so simple, Spike. This is where it's exactly what it says, getting started, where we're just going to enter in our information. We're going to enter in the assets that we have and what sort of tax bracket we're in right now and what we think that's going to be going forwards. That's the initial inputs that we put into this.
Right. And then following that, you're going to receive a report immediately. There's another page. So this is going to show us kind of what?
So this, from a basic just simplicity standpoint, this shows what an individual's potential lifetime tax bill is going to be on those retirement accounts. Not their income, but on those retirement accounts. So it's those 401ks that we've saved all that money and that pre-tax money. This shows us we're going to pay this much taxes if we don't do anything, if we just keep on the same route, versus if we look at some of the other strategies out there like Roth conversions, which is what this shows us as to how we may be able to reduce it significantly in a lot of ways.
Okay, so what we're going to do is talk about some solutions that we can get to here. So you can go to the rdwtaxtest.com. You can get your own report. It is absolutely free. And then it's what you do with it. That's what we're going to talk about when we get back. So please don't go anywhere. How do you get more tax efficient with those retirement savings that you've been saving into for decades? We're going to discuss exactly how when we get back right after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Wealth in the Winner's Circle with Harley Shanklin and Dave Williams of RDW Financial Group. In fact, if you'd like to learn more about them and the team, you can go to rdwfinancialgroup.com. We're talking about how we can get more efficient with those retirement accounts.
Absolutely.
You had a word of warning, though, Dave. Why were you worried about?
Yeah, what I was going to simply say, though, so for those of you that are using 401ks and IRAs, and we hope you are, when you do that calculator and you go online, I might suggest you have somebody with you, because when you see that tax number come at you, you might just literally pass out and have a shock of your life. Public disclosure, safety caution.
Safety and caution.
Actually, in all seriousness, the numbers can be staggering. And that's why we do what we do about the tax planning.
And for the viewers out there, so think for yourself how much you have saved in those tax-deferred accounts. So then, Harley, you go through the tax test. What kind of steps and measures then do you talk about? Because if you go and take that information to your regular CPA and say, I still want to pay as little in taxes this year as possible, that's not changing the perspective.
You're exactly right. And here's the first problem that we see when people are just focused on their CPA or tax preparer helping them try and figure that out, because they don't have a view of everything else that's going on in your lives out there. They may not understand what other sorts of accounts you have and how best to advise you on the total plan. And that's what we specialize in through our retirement start process, is making sure that that tax strategy is in alignment with everything else, whether that's instituting a Roth conversion strategy for you where we're taking little bits of that pre-tax money every year, paying the taxes at all-time low rates that we're having right now, converting it over into a Roth where you are never going to pay taxes on it again, your family's never going to pay taxes on it again, and setting up other options for that tax-free income in retirement.
I want to ask you the particulars in a second. What exactly is a Roth conversion? Let's give a definition for everybody out there. But Dave, isn't the first thing that you hear from people is, I'm not worried about my taxes in retirement because I'm going to pay less in taxes. I don't have an income anymore.
You know, that's a common myth that your income is going to be less in retirement. Yes, you're not going to have a steady paycheck. That's going away. But you're going to have Social Security. You're going to have what we call required minimum distributions that have to come out of this tax bomb known as a 401k or an IRA. You may be one of the fortunate ones that has a little bit of a pension. And the reality is that taxes are on sale, all right? So not done properly, they can have a very adverse effect on your Social Security, on your Medicare premium, and people go, wow, I didn't even know that existed. So yeah, there is time now. Taxes are probably going to be going up in the future. We do know that this year, 2025, we're still under the tax cuts from 17, and unless Congress does something this year and changes it or kicks it down the road, they could go away. So we just don't know. But we don't want to bet our future retirement on, I don't know.
The other important thing that I think is important for folks to realize out there is many times Americans are confused and don't realize that they pay regular income taxes on these pre-tax accounts.
Correct.
And, you know, Spike, I don't know about you or the viewers out there today, but are you going to eat less food? Are you going to use less electricity? Yeah, you may not be commuting to work, but I would venture to guess that folks are going to be traveling in retirement, doing those sorts of things. So we typically don't see a drop in income need out there. You're all going to be living the same life, the same lifestyle, which I hope for you, but that takes planning.
You know which day of the week I spend the most amount on? It's usually the first 4 hours of Saturday. I start getting to the honey-do list. I start going to the hardware store and the grocery store and the dry cleaners, and all of a sudden I've dropped a couple $100 out of my pocket, and it's not even noon yet.
And
I haven't met anybody for lunch yet. Haven't gone out and done anything, taken anybody out. And so in retirement, every single day is that fantastic Saturday. Yep. So to say that your taxes are going to go down because you won't have an income, you're still going to be drawing. Now, there's a few things that will change. You don't have to save for your retirement because you're in retirement. So would you arguably say that you might spend around 60, 70, 80% of what you did during your working years? Is it fair around there?
You know, we have clients on all sides of the fence on that. Here's the scoop. The things that they're not spending on, the commuting work, the lunches, paying out, and all the things, they're substituting with more rounds of golf, more trips to the clubhouse, more RVs, more taking care of grandkids. My wife loves to spend with my grandchildren. Not cheap, right? But something you do out of love. Or helping the kids now that you can't work, doing other things. So, yeah, there are some basics that are going to come down. There's no question about it. But then replace that with other things, and it's a wash.
Spending.
Yes.
Then you're also going to have your taxes that you have to pay on these accounts.
Right.
And then I don't think our healthcare costs go down as we go deeper into retirement, do they?
And they get more as you get older. You know, as we age, our healthcare needs increase. Vision, dental, long-term care, gosh forbid, assisted living. You know, nobody wants to think about those things or admit those things when we're in our 50s, 60s, 40s. But you start getting your upper 70s or low 80s. My mother is now 91 years old and has gone into assisted living. I never in my life Would have expected her to do it. The good news, when I started, first thing we did was got my mom and dad a long-term care nursing home policy. So she's now covered. But I've seen the cost firsthand, and if you don't have a plan for it and you need that, Molly stopped the bus.
Yeah.
It's an eye-opener, and it can be devastating.
Exactly. And you know, our favorite IRS, or the IRS, does not care if you're paying your medical expenses from your IRA, your 401k. It's income to them.
Right.
There is no break for that. And so it's very important, because that is going to be a major cost for us going into retirement, because we're typically going to use more and more as we get further and further into it, whether it's regular doctor visits all the way into long-term care. And once again, it does not matter what you're using that IRA to pay for, it's going to be taxed in the same exact way.
So the RDW Tax Test, I'd like to bring that back up onto the screen right now again. This is a free tool right now to show people how much currently they would pay in taxes on all of their tax-deferred savings accounts. Then it's what do you do with that information? I got a couple of minutes here. Can you give me a quick definition? What is a Roth conversion? What do you mean by that?
Roth conversion simply is taking this pile of money that you've saved inside of a pre-tax account, be it a 401k or traditional IRA, and it's where we take the money out, pay taxes at today's known rates, which as we've said are at all-time lows right now, and then place it into a Roth IRA where we're never going to pay taxes on it again. So we're controlling how and when you're paying the taxes on it. How much of a tax bill do you want to have on your account? You have to take proactive steps in that. The IRS is not going to help you with it, and that's what we are here to do with this special tax report that's custom just to you, where we can then sit down, answer your questions about it, and show you the strategies, the tools that are available to help reduce that tax bill over time.
I think one of the things that's frustrating for Americans is when you feel like you don't get to make choice,
right,
that somebody else is making it for you. And especially when it comes, just say from the government and IRS, that it's really frustrating. Here is a way that you can take back the control. You can control when you pay your taxes, at what rate, rather than just waiting until every April 15th in your retirement years ago, okay, what do I have to pay? Dave, this is taking the control back, and here in the Midwest, that's what we want.
Yeah, and it's one of those things, Spike, that the longer you wait, the less, quote, effective it is. Because when you hit 73, the government forces you to start taking money out of that IRA, and you've got to take that first before you can convert. I run into cases, and I have several clients who will probably never want that money from their IRA. They just don't need it. However, they have children, and they're very concerned in today's environment about what this world's going to look like for their children and their grandchildren. Under the current laws, when they die, their children have 10 years to get that money out of the IRA, and they will have to pay tax on it at their tax rate. Imagine having two children with, $1 million IRA, inheriting $500,000 piece, knowing they have to take an additional $50,000 of income every year out on top of what they're currently making. These are Roth conversion opportunities. It's not just the taxes for the client. It's about the legacy for not only the client, but their family.
You want to talk about how you build generational wealth? You want to look at the Carnegies, the Mellons, the Rockefellers? It literally is through efficient tax planning.
Absolutely.
And we can help you with that right now. Go to RDW Tax Test. First, find out with this absolutely free tool how much you're going to pay in taxes on all of your tax-deferred accounts. Then come on in, sit down with us. We'll talk about the tax strategies, things that you can do, might not be able to do, but we'll show you what those strategies are. More of Wealth in the Winner's Circle and solutions for your tax strategies when we get back right after this.
As a kid, I wanted nothing more than to be a hero. But little did I know I would actually get that opportunity, and it really started for me. The catalyst was 9/11. And as the war on terror continued to unfold, I put my money where my mouth was. And I ended up landing with the 101st Airborne Division and became a light infantry medic with them. And I spent a total of 28 months deployed overseas. I had the opportunity to serve with some of the greatest men and women that this country has to offer. And I had the blessing and honor to meet my wife through that journey. And after 10 years of serving in active duty, we started to build a family. Our son Leo was born, and I quickly realized that it wasn't the environment that I wanted to raise a family in. It meant moving around, and it meant risking my life in ways that may put me in a position that I may not be there to play catch with my son, right? To walk my daughter down the aisle eventually. And so I started looking for other opportunities, and that was when my father-in-law came to me, and he ran a financial planning and wealth management firm in Indianapolis. The relationships that he was able to build with his clients, it really resonated with me because I felt that same care with those men that I took care of overseas. And so I made the leap, became a financial advisor, and I like to think that I've continued that mission. Rather than their medical hero, I'm their financial hero.
Welcome back to Wealth in the Winner's Circle with Harley Shanklin and Dave Williams of RDW Financial Group right here in Indiana. We were just discussing the Roth conversion and how it can make it more efficient for your retirement spending. But you have said you've heard this before. People will come to you at the end of one of your live events and say, oh, I can't contribute to a Roth account. I make too much money.
Yeah, that's a big misconception. And used to be true, there weren't things such as a Roth 401k. Wish they had been available when I was young. I would have fully taken advantage of knowing what I know today. But here is the opportunity. A lot of 401ks today, and we assist clients in determining if they're available for them through their employer, can contribute to the Roth just like they would to their 401k in a Roth environment. In other words, they'll pay tax on the money today, but going forward, all earnings, that money will be tax-free for the rest of their lives. And the added bonus, at age 73, they're not forced to take money out. It never counts towards the taxation of their Social Security. It's a beautiful thing.
So let me ask you, fellas, if somebody's watching this, they figure out, oh, a Roth 401k, I can contribute to that. Now, first of all, for folks, you can't contribute to both at the same amount, meaning you can't put the same $30,000 if you're over the age of 50. But you could do some into a regular 401k, you could do some in the Roth, you could split it or completely change. But is it worth it for somebody to do it for 1 or 2 or 3, 4 years if they're about to retire soon?
Well, there's only one way to find out. There's only one way to find out the answer to that, Spike, and that's to schedule an appointment to sit down and go through your individual situation so we can determine what is the right number. Should we be contributing everything to pre-tax or everything to Roth or a mix between the two, right? It's different for everybody out there, but it takes sitting down, evaluating your savings rate, your tax situation, and everything else, all the other types of accounts that someone has to determine what is that answer.
All right, so the Roth conversion, this is something for folks who have saved tax deferred for probably their entire lifetime. Roth conversion, we can find out if it's worth doing. So let's say, I'll give an example. Let's say you've got an account of $500,000. Which is pretty reasonable, and there's a lot of great big companies around here, you know them.
Sure.
You don't have to do it all at once, do you? Or can I do a little bit at a time?
No.
Absolutely, we recommend not to do it all at once, because remember, that $500,000 is going to take your current tax bracket and multiply it up, because you're going to go from $500,000 plus what you make. No. And this is where the S.T.A.R.T plan comes in. We actually plan it out. We can actually show you what the conversion would look like over how many years. When does it make sense? When does it not make sense? I mean, I've had some clients that they retired and all of a sudden had a very big opportunity to do a consulting gig for 3 years. Their income went from a certain level here to a new level. It doesn't make sense to convert because we know their income is going to come back down the road. So every conversion is unique. I will say this, the younger you are, the better you are. The more times it gives us to put together a plan to get you from here to there.
All right, so Roth conversion, Roth 401k, worth using, Harley?
Oh yeah, in the right situation it is. And here's the one thing I'll tell everybody out there watching today is this isn't something that you just want to do willy-nilly on your own, because when you do Roth conversions, it can have a significant impact not just on your taxes, but on your healthcare costs. For those of you out there who are retired and are on Medicare, that is based on your Medicare Part B premiums is based on your income. And when you do a Roth conversion, that is going to count as income. And the last thing that we want to do is see you trip over that IRMA tax and have your Medicare Part B premium skyrocket by 80%. That just doesn't make sense. So let's sit down, go through it together to ensure that you're not paying too much and you're being as efficient as possible.
Let me review, and hopefully I learned something from you both today. So if we can convert, or if we can start using a Roth 401k, or if you are able to contribute to a Roth IRA, the benefits in your retirement years of using Roth accounts, you said, I don't have to take it out for RMDs because we've already paid taxes. It doesn't count against Social Security for your provisional income, which means now you're keeping more of your own Social Security.
Correct.
And then the legacy benefit, rephrase that for me again when we're leaving it.
Legacy benefits, your children will not have to pay tax on that money either.
And when we say children, I mean, let's say, as we were talking about your mom in your 90s, and I've had grandparents into their mid-90s, we could be talking about adult children who are in their high earnings years. So
absolutely.
So you're making it more efficient for them, keeping more of it, like I said, just like the Rockefellers and the Carnegies. Folks, we talked a lot about taxes. I'm going to give the both of you some time to think about this here. The 5 steps in your S.T.A.R.T method, that when people reach out, they come into the office, you're going to go through them. But folks, the entire retirement plan, one of the things, of course, is the tax strategies. But there's many different elements to working with an independent financial advisory team who want to help you with all of the different strategies. Harley, I'll start with you. The S.T.A.R.T method for retirement planning, what is it?
It's pretty simple, Spike. It's secure income, tax efficiency, advanced planning, risk management, and a tailored investment strategy. All taking all the pieces of your retirement puzzle out there, putting them together in a simple to understand follow-on guide to help you have the successful retirement that you deserve out there.
Dave, you've always been highlighting the team and the whole group of people back there. So it's not just you running the numbers, and it's not just Harley running the numbers. You've got the team back there helping you, the investment management strategy, the partnerships with taxes and estate planning, even those Medicare choices.
Right.
It's a whole group behind the RDW Financial Group, correct?
That is correct, and we do that on purpose. I'm not a spring chicken anymore. None of us know when our last day is, but we do that for the client. The other thing it does is it brings a perspective in from each and every one of us. I've never known that one person has the right answer for all, so.
All right.
That's what
Thank you both so very much. Folks, you can get started on your own free written financial plan with the team. Call that phone number, call it right now. There are literally people standing by who will schedule your appointment. Or you can scan this QR code right here with your phone, click on it, you can schedule your own appointment. Thanks for watching Wealth in the Winner's Circle. We'll be back next week.